curve. That's what makes price go up. Another important point here is that supply and demand zones are stronger when the movement right after the zone produces a confirmation about the intent of the market player that produced the zone in the first place. For example, in this illustration, we can see that after the demand zone, buyers were able to create a higher high, and that means these buyers still have enough momentum to be trusted in the future. If these buyers were not able to create the higher high, it would be more dangerous to trust their demand zone in the future because of a lack of bullish momentum. Let's summarize a few guidelines about the demand zone. The low between two highs is where a significant demand shift happened. The market will seek a new equilibrium by producing a movement up the supply curve. Price will rise as a result of this movement up the supply curve. The demand zone will form in the low between two highs. The second high must be higher than the first one for the demand zone to be strong. We can extend this zone horizontally to project the next possible significant low. Let's now look at the supply zone example. In this illustration, you can see price going down. The high that is formed between two lows is where the supply zone will be. In other words, a supply zone will be near a high. By extending this zone into the future and counting on the basic premise of price action, we can count on the fact that if price comes back there, the same sellers that made price fall the last time will do it again. The high out of which the supply zone comes is a place where the supply curve has suffered a tremendous shift to the right. So now the market will seek the new equilibrium by producing a movement down the demand curve. That's what makes price go down. Another important point here is that supply and demand zones are stronger when the movement right after the zone produces a confirmation about the intent of the market player that produced the zone in the first place. For example, in this illustration, we can see that after the supply zone, sellers were able to create a lower low. That means these sellers still have enough momentum to be trusted in the future. If these sellers were not able to create the lower low, it would be more dangerous to trust their supply zone in the future because of a lack of bearish momentum. Let's summarize a few guidelines about the supply zone. The high between two lows is where a significant supply shift happened. The market will seek a new equilibrium by producing a movement down the demand curve. Price will fall as a result of this movement down the demand curve. A supply zone will form in the high between the two lows. The second low must be lower than the first one for the supply zone to be strong. We can extend this zone horizontally to project the next possible significant high. In summary, we know that a demand zone happens in the low between two highs where the second high is higher than the first one, and a supply zone happens in the high between two lows where the second low is lower than the first one. Knowing where zones are roughly located is one thing. Knowing exactly how to draw them is another. So next we are going to establish some rules and guidelines to draw the supply and demand zones. Since we are talking about a zone, we need to establish two lines since a zone is formed by the space between these two lines. One of these lines is easier to establish, and the other depends on each market scenario, unfortunately. Let's begin first with the demand zone. In a demand zone, the easier line to draw is the lower one. All you need to do to be safe while drawing this line is following the absolute low in between the two highs in question. In theory, the next possible significant low can retrace all the way down to this low out of which the zone comes. The difficult line to draw in a demand zone is the upper one because it depends on each individual market situation. The rule for this upper line is that you need to identify a level where buyers really decided to bring price up, but it needs to be a different level than the absolute low, since that's already being used for the lower line of the zone. We'll observe some examples of this in just a moment. In a supply zone, the easier line to draw is the upper one. All you need to do to be safe while drawing this line is following the absolute high in between the two lows in question. In theory, the next possible significant high can retrace all the way up to this high out of which the zone comes. The difficult line to draw in a supply zone is the lower one because it depends on each individual market situation. The rule for this lower line is that you need to identify a level where sellers really decided to bring price down, but it needs to be a different level than the absolute high, since that's already being used for the upper line of the zone. Basically, you need to identify the absolute market extreme and a level that highlights an important decision from the market players. Before we move on to the examples using real price charts, let's quickly go through another important aspect of supply and demand zones, which is the risk management property built in this technique. By definition, a supply or demand zone will provide a logical place to put a stop-loss order that is near the entry point. That implies that we have a small and logical stop-loss order that has the protection of the market player in question, but with a good headroom for the take-profit target. In summary, supply or demand zones provide a small and logical stop-loss with a large potential take-profit target, which is an absolute necessity if you want to survive trading in the long term. In other words, using a risk-reward ratio of 1-to-3 or 1-to-4 with supply and demand zones will make sure you can make money even if you are wrong more than 50% of the time, because it will take a few losses to wipe out one profitable trade. If you use a 1-to-3 risk-reward ratio, you can lose 75% of the time and still break even. If you use a 1-to-4 risk-reward ratio, you can lose a whopping 80% of the time and still break even. All of that, of course, assumes that your stop loss and risk is the same in all trades. Trading is not about achieving the highest win rate possible. It's about having enough room to make mistakes and still make money. Let's now move on to practical examples, as it will become much clearer what supply and demand zones are all about. I should tell you first that supply and demand zones work in all time frames and in all markets, so you don't have to worry about that. As I said before, the mechanism of supply and demand is something that underlies all markets. In this first example, we'll analyze a demand zone. Notice that we have two highs where the second is higher than the first, so the low in between is where the demand zone is. As I said before, finding the lower line of the demand zone is simpler since you can always go to the lowest point of the low in between the two highs. The more difficult part of the demand zone is finding out where the upper line of the zone is. To find this line, we must ask ourselves where did the buyers really decide to bring the market up after the lowest point of the low in between the two highs. If you look carefully, there's an increase in volatility right after the lowest point. This increase in volatility is highlighted by a larger bullish candlestick. The point of origin of this candlestick, meaning its opening value, is where the buyers from this demand zone really decided to bring the market up. So in this case, we can assign the upper line of our demand zone to the opening of this candlestick.